It looks like we are currently witnessing the beginning of a global debt crisis. The US 10-year government bonds yield has been rising from 3.9% to 4.5% in just the last 3 months. At the same time, the Japanese 10-year government bonds yield rose from 2.1% to 2.7%, while the German 10-year government bonds yield surged from 2.6% to 2.9%. This is not happening by coincidence. History shows that there are certain reasons for why bond yields are currently rising like this, and so in today's video we are going to discuss those reasons and whether they are about to cause a major recession once again. Now, in order to understand why global bond yields are currently rising, it's essential to first understand how the bond market is actually working. The global bond market is, with a market capitalization of around $140 trillion, the biggest financial market in the world. Governments issue bonds in this market to receive funding from private investors, institutional investors, or central banks. Those bonds have a price and a yield which always move in opposite directions. And so as bond yields are currently rising, that is happening because of falling bond prices. You can think of the bond yield as the interest rate the market demands in order to lend money to governments. And the bond yield is so important because it's where, for example, mortgage rates, corporate borrowing costs, and long-term loans are derived from. So now the question is, why are bond yields rising? In order to answer that question, we have to take a look at this chart. This chart shows you foreign holdings of US Treasury bonds. You can see that while nations like the UK and Canada have increased their exposure to US Treasury bonds, nations like Japan, Brazil, India, and China have been increasingly selling US Treasury bonds in recent years. Those nations rapidly selling US Treasuries has a massive impact on the price of those bonds, as foreign holders make up around 1/4 of all the US Treasury bondholders. In addition to that, the US Treasury holdings of the Fed, which today make up around 1/6 of overall holdings, have also declined since 2021. So not only nations like Japan, Brazil, India, and China dumping US Treasuries, but also the selling pressure coming from the Fed have been causing US Treasury bond prices to decline significantly over the last few years. And as we have just learned, falling bond prices also mean higher bond yields. And so, in order to understand why bond yields are currently rising, it's important to understand why nations like Japan, Brazil, India, and China are currently selling those bonds. And there are many reasons for that. First of all, the US government debt exceeded $38 trillion, as the US debt to GDP ratio has been skyrocketing, reaching levels last seen during World War II. The trust in the US government to repay the rising debt without devaluating it excessively is declining. This is leading investors demanding higher risk compensation in the form of higher bond yields. And so this is one of the reasons why US Treasury bonds are currently being sold all around the world. In addition to that, trust in the US government has also been deteriorating in response to the US freezing Russian assets in 2022 after Russia invaded Ukraine. Since then, other nations fear that exactly that could happen to themselves as well. But declining trust in the US government is certainly not the only cause for falling bond prices, because if you take a look at inflation and bond yields, you can see that they are closely correlated. Whenever consumer price inflation has been rising, as for example in 1970, 1973, or 1980, that ultimately also led investors demanding higher yields to receive compensation for rising inflation. In the last few months, inflation has once again been picking up in response to the supply disruptions following the closure of the Strait of Hormuz. In result, bond yields have been rising as bonds with yields below or near the rate of inflation are getting unattractive. Think about it. Why would you buy a bond with a yield of 4% if the inflation rate is 4% as well? This would mean your real return is 0%. And as nobody wants a real return of essentially nothing, bond prices have continued to fall, pushing yields even higher. And this is where everything comes together. History shows that rising bond yields do not only coincide with rising inflation, but often also preceded recessions. You can see that the 10-year government bonds yield has been rising previous to the recessions in 1970, 1973, 1980, 1990, 2000, and 2008. Now the question is, why are bond yields rising before recessions? Well, it's actually quite simple, and there are two main reasons. The first reason is that bond yields always move up with rising inflation. As inflation is rising, spending in the economy is decreasing, which then often leads to a recession. The second reason is that higher yields also mean rising borrowing costs throughout the entire economy, which also leads to decreased spending, ultimately causing a recession as well. Now let's put all the pieces together to understand how the US is currently trying to solve this issue. The problem the US is currently facing is a problem of declining demand for their US Treasury bonds. When the demand for those bonds is declining, that causes bond prices to fall. Now, when bond prices fall, bond yields are rising. When bond yields are rising, the cost of borrowing increases. But now you can say, well, at least rising interest rates keep the rising inflation under control. The problem is the US government cannot afford such high interest payments on the $38 trillion of debt that have been accumulated over the last few decades. So it seems like the US government is trapped here. Because if yields are falling, nobody wants to buy the US Treasury bonds and inflation continues to increase. And if yields are rising, the US can't afford to pay the interest on those US Treasury bonds anymore, leading to the US ultimately defaulting on the accumulated debt. Well, we at Chronos believe chances are high that the US is going to choose the first path, as it is the one it always chose to take throughout history. This path consists of two aspects. First, the US is forcing foreign demand for US Treasury bonds, as it did in the past with the petrodollar. This is one of the reasons for why the US is currently attacking Iran, because as oil and gas infrastructure is being destroyed and as the Strait of Hormuz is blockaded, nations are now once again forced to buy energy from the United States using US dollars. So the petrodollar has essentially returned in order to secure demand for the US dollar. The second aspect is forcing domestic demand in the form of purchases of US Treasury bonds by the Fed. This way, bond prices are rising, while bond yields are falling, decreasing the amount of interest the US government has to pay to the bondholders. Simultaneously, this is diluting the money supply, decreasing the real value of the debt as the currency depreciates. Now, it's hard to predict whether the US is going to be able to continue this Ponzi scheme of rolling over debt, and so we should rather turn to the question, how should you position yourself in this scenario? Well, as inflation is rising and the US dollar is being devalued, exposure to scarce assets is absolutely necessary to preserve and grow your capital in this kind of environment. As the stock market is likely going to suffer when adjusted for inflation, sectors like precious metals, energy, and consumer staples are getting increasingly more attractive. So if you have any further questions, don't hesitate to ask them down below in the comment section. And if you found this analysis valuable, please subscribe to our channel and hit the like button, as it helps us reach out to more people who need to understand what is currently happening. Thank you for your time.